the system that almost broke itself. It began with a glitch so small that most traders never noticed it. A delay here, a missing quote there. Nothing alarming, just a kind of digital hiccup that happens in a world built on code. But that tiny fault was the first hint of a crisis brewing deep inside the market's machinery. This story matters now because financial systems are no longer slow, human-driven networks. They are electric, automated, and woven together by millions of lines of code. Prices react in microseconds. Algorithms compete for nanoseconds. And in this hyperconnected world, a single malfunction can ripple through the entire structure with terrifying speed. To understand how close we came to disaster, we need to revisit the moment when the system began to unravel from within. It started with an upgrade pushed into production during a quiet overnight window. Engineers believed the patch would improve efficiency, reduce latency, and smooth order flow. The update passed every test. It behaved flawlessly in simulations. But the real market is not a simulation, and when the first morning orders arrived, something deep in the logic misfired. A handful of quotes posted at the wrong prices. Orders routed to the wrong venues. The discrepancies were tiny, fractions of a cent, milliseconds out of sync. At first, the errors canceled one another out. But as volume increased, the imbalance grew. The system that was designed to coordinate liquidity began creating distortions instead. The early reveal emerged when market makers noticed odd behavior in their fills. Trades that should have executed instantly hung in place. Quotes appeared, vanished, then reappeared at impossible speeds. High-frequency firms detected anomalies in their latency maps. Signals at the core of the market wasn't responding normally. Most participants ignored the signs. Morning volatility, they assumed. A busy open. Nothing more. But the veterans felt the tension. Markets have rhythms, and this rhythm was broken. As the first hour passed, the distortions multiplied. Instruments that normally track together slipped out of alignment. Spreads widened without reason. Volume arrived in sharp, unnatural bursts. And deep within the system, the flaw continued to propagate. Quiet, hidden, waiting for the moment when pressure would turn into something far more dangerous. That moment was approaching quickly. And when it arrived, the market would discover just how fragile its foundations had become. The instability deepened as the flawed code continued to ripple through the system. What began as microscopic distortions evolved into noticeable fractures across interconnected markets. Algorithms designed to detect inefficiencies suddenly found dozens. Too many, too frequent, too perfectly structured to be real. Some seized the opportunity and traded aggressively. Others froze, unable to determine whether the signals were genuine or ghosts created by a malfunctioning core. The reveal intensified when a major exchange reported unusual latency. Orders that typically process in microseconds now lagged by entire milliseconds, an eternity in automated trading. Market makers widened their spreads, unsure whether quotes they were seeing were accurate. High-frequency firms switched to defensive mode. A few shut down entirely, unwilling to risk trading against a fractured system. But the most telling sign came when two highly correlated assets diverged sharply. To human eyes, the move looked bizarre. To machines, it looked like opportunity. Algorithms triggered trades at lightning speed, exploiting the apparent mispricing. Yet every correction they attempted only amplified the underlying distortion. The system was feeding on its own error. The early conflict formed when a single firm reported an enormous loss tied to misexecuted orders. Their trades have been routed into a loop, an unintended cycle created by the software update. Every time the firm attempted to correct its exposure, the loop re-triggered, multiplying problem. Risk officers issued alerts across desks. Other firms checked their logs. Soon, multiple institutions reported similar anomalies. Engineers scrambled to diagnose the fault. They combed through logs, ran simulations, traced packet routes. But by the time they identified the source, the malfunction had already broadcast itself across interconnected exchanges. Fixing one venue would not stop the instability. The problem had become systemic. The chaos spread outward. ETFs slipped away from the values of their underlying assets. Futures decoupled from spot prices. Arbitrage strategies malfunctioned. Screens filled with movements that no analyst, no trader, no algorithm could explain. What traders saw was disorder. What the machines saw was fragmentation. Regulators received the first wave of emergency calls. Firms feared that continuing to trade could result in catastrophic mispricing. Some requested trading halts. Others pleaded for intervention. But halting the market carried its own risks. Confidence could collapse instantly if the public believed the system itself was broken. As the second hour of trading began, the distortions compounded. Each new trade was built on flawed data. Each flawed trade created more flawed data. The system was bending under its own weight, spiraling toward a point where it might become impossible to unwind the damage. The moment of crisis was no longer a distant threat. It was already forming in real time, buried inside the very code the system depended on. The break hit with stunning force. A major exchange suddenly froze. Not a scheduled halt, not a volatility pause, but a full stop. Orders queued without execution. Quotes vanished. For a few seconds, the screen looked like a still image. And then, like a machine rebooting mid-operation, the entire exchange flickered back online with prices that made no sense at all. Chaos erupted instantly. Algorithms that relied on continuous data panicked. Some dumped positions. Others overloaded backup routes. Trades fired at prices far above or far below reality. The gap between markets widened into a chasm. Derivatives spiked in one direction, while cash markets cratered in another. It was a kind of fracture that analysts had warned about for years, but seeing it unfold in real time stunned even the most hardened traders. The conflict intensified when multiple exchanges began to drift out of sync. Timestamps didn't match. Routing tables contradicted one another. An order that should have filled in New York was executed at a different price in Chicago. Cross-venue arbitrage became impossible. Machines tried to correct the gaps, but the corrections amplified the damage, triggering more loops, more errors, more chaos. Trading floors erupted with urgency. Risk managers shouted across desks. Phones rang nonstop. Engineers sprinted between terminals. Everyone searched the same answer. Was this a cyber attack, a malfunction, or a full-blown systemic failure? But the truth was more unsettling. This wasn't sabotage. It wasn't malicious. It wasn't even intentional. It was the unplanned interaction of millions of lines of code, each written for efficiency, each optimized for speed, each never meant to collide in the way they were colliding now. The unraveling spread into global markets. European indices twitched violently even though their trading day was nearly over. Asian futures plunged despite no news from their economies. Currency markets whipsawed as arbitrage paths collapsed. Gold spiked, then crashed, then spiked again. Nothing behaved logically because the system generating the logic was broken. Engineers finally pinpointed the core flaw. The overnight update had created a feedback loop between liquidity algorithms and routing algorithms. When one withdrew liquidity, the other rerouted orders into markets with even less support, triggering more withdrawal, more rerouting, more instability, a spiraling chain reaction. Inside the command center of the biggest exchange, an executive made the call no one wanted to make. Prepare for a coordinated shutdown. It was a last resort, the financial equivalent of pulling the plug on a life support system. But leaving the markets open risked something worse. Prices so distorted they could never be unwound. Traders sensed a shift. Voices quieted. Screens reflected the growing distortion. The entire architecture of modern finance, automated, interconnected, fragile, was grinding toward a point of irreversible failure. The buildup had reached its peak. One decision now stood between restoration and disaster. And the system, for the first time in its history, was close to breaking itself. The shutdown order came fast. Exchanges coordinated behind the scenes. Regulators gave emergency approval. And within minutes the market began powering down, one venue at a time. It was a financial equivalent of pulling breakers in a burning building before the flames reached the foundation. The climax unfolded in eerie silence. Screens froze. Order books vanished. Price feeds went dark. For the first time in decades, the world's most advanced financial system stood still. Traders stared at blank monitors, stunned by the magnitude of what had just happened. A market built on speed, automation, and constant motion had been forced into stillness by its own internal collapse. Engineers worked through the outage like surgeons. They traced loops, patched code, isolated corrupted clusters. Each problem solved revealed another buried deeper in the system. The flaw wasn't a simple bug. It was a cascading interaction of algorithms no one had anticipated. For years, speed had been prioritized over understanding. Efficiency had outrun safety. And now, the cost had arrived. When the markets finally reopened, the resolution emerged with almost fragile clarity. Prices reset. Liquidity returned in cautious steps. Algorithms rebooted under tighter constraints. The system steadied, then held. The immediate disaster had been avoided, but the shockwave lingered. In the days that followed, analysts dissected the event with a mix of awe and dread. They realized how close the world had come to a catastrophe, not because of a war or a crash or a scandal, but because of code written to make things just a little bit faster. A reminder that complexity, when left unchecked, becomes its own kind of risk. The lesson spread quickly across the industry. Engineers demanded safeguards. Regulators pushed for transparency. Firms reviewed the assumptions buried deep in their automated systems. Everyone understood now. The market hadn't been attacked. It hadn't been manipulated. It had simply collided with the limits of its own design. Modern relevance couldn't be clearer. Today's financial system moves at speeds no human can follow. Algorithms react to algorithms. Code watches code. And behind every millisecond of price movement lies a structure that must remain perfectly balanced. Because even the slightest imbalance can cascade into chaos. Sometimes the smallest shift in perspective becomes the beginning of a new future.